Yeah. That looks good, right?
Yeah, it's all turned on.
Yep, thank you. What is it? Yep. So this is not part of the course plan, but an opportunity came to discuss something here. So I did a quick research. I can even show you how I did that, so that it's like nobody provides me with the solutions, and so nobody will provide you with the solutions. You create the solutions. That's why you're the professional hired by somebody who can provide a solution. And then we'll do chapter 2, time value of money. That's the plan. And then around 8:30. We'll have the Harvard management case. So it's a simple sort of straightforward class today. So here, what are you looking at here? Is I get this, 3-4 times a semester every year for many years, and I got this wonderful email actually from one of us actually, and. You're okay identifying yourself? It's absolutely fine, yeah. So Ba wrote to me, she says, since 1990, my mom, who never took a business class in her life, 1990, not 2000, okay, started investing in stocks. Every night after work at 11 p.m., my mom sits and watches CNBC Mad Money. The Mad Money, for those of you who know, the show by Jimmy Cramer, a really bright guy. She thinks that now that I'm taking finance, that I can get her money back that she lost. I mean, so I was reading this, but this is an amazing phrase that she just slipped it in, So, I mean, 23 years of investing, and there isn't a positive net return on the investment. And then she says, that. And I think Jimmy Cramer came on the class last time also. So, how did I go about it? This was maybe like 3 o'clock in the afternoon. So I could have done some other things as well, but I said, hey, no, this is a nice opportunity here. And so just sharing this with you, maybe 90% of you know, but those of you don't, go to scholar.google.com. It automatically, it first hits our scholarly articles, which are basically peer-reviewed journal papers. And in there, I just put in Jim Cramer. So you just my phrase was stock performance and Jim Cramer, just that. And I got about 6-7 papers. You can click on it and you'll get them. But I quickly looked at one of them. So here's what it is. Mad Money. So this paper is published in actually a very good journal, Journal of Economics and Finance, 2010. So somebody has done, this must be a lot of work, tracking all the recommendations of Jim Cramer over a certain time period. We examined the stock recommendations of Jim Cramer, televised on CNBC's Mad Money, and document significant market reactions, i.e. announcement returns and volume to Cramer's recommendations, particularly for small cap stocks. Everybody knows what small cap stocks are? No? Okay. Yeah. See, these are, we can, so let's say the S&P 500, you can rank them 1 through 500. As simple as that. Currently amongst the top 3 are Apple, ExxonMobil, and maybe Walmart. Huh? Anybody? Or something, one of them, And then you have other companies, Home Depot here, Pfizer here, and then you have smaller companies here, let's say Fabrinet or, Qualcomm, and so on and so forth. So small cap companies are basically companies that have small market capitalization. Market capitalization of Apple is about $300 to $400 billion, about $400 billion. So these could be typically less than $1 billion. That's small cap. There's an ETF actually for small cap ETFs. You should check it out, IWM. It's an amazing ETF actually. It has 2,000 small cap stocks in it. So instead of buying 2,000 individual companies, if you pay $10 commissions, that's $20,000 in commissions right there. You can just buy an ETF for that. It's one of the most heavily traded ETFs. And a large cap ETF is IWB, which is very similar to SPY. The difference is this has 500, top 500, this is top 1,000. And IWM is the next 2,000. So after 1,000, then 1,001, up to 3,000 actually. So, but that is, if you think about it, that's 2,000. It's also, see, it's all linked. This tracks an index called the Russell 2000. It's a great place to work in. It's in Seattle, Washington, this place. But anyway, it's a link, it's a tangent, but it's not really. So you got to explain that small cap stocks. So that's small caps. A lot of people like small caps because small caps eventually become large caps. There was a time when Google, Dell, Microsoft, they were all small caps, So anyway, CNBC, Cramer's program, the recommendations are particularly for small capitalization stocks. So just wanted to get that out of the way. The following findings indicate that announcement returns are primarily due to price pressure from uninformed trading, as opposed to the recommendations providing new value-related information. And then here's the line. Announcements returns reverse following buy recommendations. Bid-ask spreads temporarily decline. In fact, there's a whole paper that I've done on bid-ask spreads. If you want to be in the world of even a little bit of investing, you need to know what a bid-ask spread is. A financial asset is one of those rare assets in the world that legally and legitimately have two prices simultaneously. It has two prices simultaneously, a buy price and a sell price, a bid and an ask. And it's published. So if you want to sell Microsoft right now, you can sell it at a price. If you want to buy it, you can sell it, you can buy it at a price. What do you think is going to be? The buy is going to be higher than the sell. And that's how the specialists and the traders on the exchanges, that's how they make money. So it doesn't matter, it's the bid-ask spread. They never take a position, in a stock. And so this whole casino is organized a certain way. But anyway, the bid-ask spreads temporarily decline, which is an indication to someone who knows this literature, and I've done this also, is if there's an increase in volume, if there's a great interest in a security, there's a lot of trading around it, so the bid-ask compresses, which is a good thing. The bid-ask compresses, becomes a more liquid security, So it's like, let's say this table, This is a simple example. What do you think of this example? Table. Think of something else. This watch, yeah. It's actually a reasonably decent watch. So I bought it at a certain price. If I want to sell it, the difference between the buy price and the sell price, do you think it's going to be wide? It's going to be pretty wide, right? One is, it's a used watch. It's sort of now, dated, it's 10, 12 years old, and so on and so forth. So that's is less liquid. But suppose suddenly, George Clooney is seen wearing this watch, and it comes up on Jimmy Cramer's show. But this watch was released in 2002, so it's not there anymore. So if I go on eBay, there's a greater, maybe possibly greater interest in this watch, So the bid-ask is going to compress. So the bid-ask is actually a very technical item, but we will actually learn about this formally. There's a paper of mine on that. But that's the reason why some of those papers are in your case studies, is because those terms, they're just part of the literature. So if I want to explain something as simple as what happens to recommendations after a TV show, we're talking about a TV show, guys. And here we're talking about bid-ask spreads and not just the nuances, what the basic structure of that is. But here, bottom line is announcement returns following buy recommendations, they reverse. So next time you sit in front of TV, and it all comes to, and see, this is where I posted. Now that's what I was saying, and it's fine, but let me actually see if I can bring it up. So just try to click on these things every now and then. because I've already thought and wrote about it, so instead of recreating that. Here, I said take a look at it, Take a look, it may actually do some good. There are 3 major pieces of information. And here, the reason is this, guys. Why does it reverse? Because embedded in it is a vast literature on EMH. EMH is efficient market hypotheses, which we will also do formally in the class. It's also called market efficiency. And the whole market efficiency is, if you know it, even though you think that you have a unique insight, the very fact that you know it means that it is reasonably public information. And if it's purely and truly private information, then acting on it is illegal. So if it's truly private information, you will actually, not can, most likely because the US is a very highly regulated market, you will actually go to jail if you act on it. So avoid that temptation. And just to wrap it up here, and then you can read more on it. One implication is investors should be cautious in following stock recommendations announced in the mass media. So once again, you can actually, there are sub-branches to this. One knee-jerk reaction of sort of like, activist type viewers and investors would be like, oh, this whole thing is a conspiracy. Maybe it is, maybe it's not. We don't even have to go that far. So there are 2 real reasons. 2 big reasons actually why this is happening. One is this is part of information already. It's already in the information set. It's called its price to perfection. All that excitement about it is already there, in there. And so now it's going to sell. And of course there are times, but now the SEC has cracked on it. And people who came on CNBC and CNN or MSN, something like that, they've actually been sued or gone to jail. It's called pump and dump schemes. So these portfolio managers and analysts, they would recommend to their companies to take a position in a stock. Okay? And then because they were reasonably influential, think about how much stuff goes on there. And then they have links with the media. Then they come on TV or on a radio show and they'll talk it up. But they've already taken a position in it, right? And they don't even wait a day. That, the news goes up, the news is out there, the information, the show is there. It's called the lightning period in Jimmy Cramer's program. And they're selling the stock, But the guys at SEC are people like us, they also know what to look for. They look for unusual profits, unusual trading patterns, bid-ask spread compressions. And then, like Deep Throat said, follow the money. Follow the money, you got busted. So, but that's happening less nowadays. So now when you watch next time CNBC or something, anytime an analyst or portfolio manager, anytime she talks about a security, the anchor, she's going to ask them, in fair disclosure, do you have positions in this? And sometimes they pause, So that's that. And then I just, as you know, I didn't stop there. So, I did that. And this picture will be hard to find on the web. So I fired up my program and I said, Ba's mom, she came to this country 20, 30 years back, and what a ride she missed. So during these times, there's a lot of excitement about stocks. And what did the S&P? All she had to do is invest in, let's say, the S&P 500. How do you invest in S&P 500? Like I said, you can't invest in an index. So VFINX is one of the world's largest and most liquid and price efficient mutual funds. It's by Vanguard, anything with V, So out of 10, 15,000 mutual funds, sometimes I mention a few, there's a reason. I'm not linked to any company. I get 0 sales commission, nothing. So you can be rest assured. VFINX generated 729% over the time period. So all she had to do is what's called dollar cost averaging. Like with her monthly salary, just save a little, or every 6 months, just put it down. So here is buying on the high, but then it gets higher. Then of course it's going down, but then you're averaging it lower. Your average cost is lower, so in a way you're happy it's going down. And then eventually you're going to get a payoff just because you took on risk. But the people who are darting in and out, which is most of the traders and the fund managers, both not just retail but professional, they don't want to be here. They don't want to be here with a long position. So they want to buy here and they want to sell here. But that doesn't happen, or it cannot happen consistently. This is an annualized return of 9.3%. And so as you can see, this includes, so this brings to the third item, like there are 3 items, which brings us to the next case. So it's all linked, as you know, is very easily you can see that we have been in 2 massive bear markets, and this is the July 2011 crash when the US was downgraded. And I'll use that a little bit in the Harvard management case stress test scenario. So now this is the third piece of information that I sort of slid it in there. That's a segue into our next case. The above graph includes dividends associated with VFINX, which is the largest index fund that tracks the S&P 500. Excluding that, it would be about 325%. So think of the loss function there. So I actually went to big charts and a couple other places. And just because I don't want to put too much information in front of you, if you add the other graph, it would be like half there. So that's what investors are seeing. So that would be 325%. So literally more than half the growth in the S&P 500 is coming from the dividends that are reinvested. And pretty much the annual average dividend rate on the S&P 500 is about 2.6%. Think about that. So people think that it's chump change. And so, the final point for investors, both retail and pro, that dart in and out, it is impossible to consistently, the operative term is consistently, catch the inflection points, hence the underperformance. Not to mention, when you're trading there, not to mention the trading cost and the tax event. Because anytime you trade, it's a tax event. So you have to, there's a cash outflow, especially if you have a profit. So that was the unplanned research note of the day. Captures everything. All right. All right, let's maybe close this door here. There's like a AMA. This is going to be a regular event because the AMA has a meeting here, 5 to 6. Does anyone have any questions or thoughts, comments? Yeah. All right. So time value of money, guys, chapter 2. Theoretically, I should not be doing this chapter. Because it's something that is assumed that someone who is coming at the graduate level is exposed to or familiar with. But a few sample points I have, it's like, so for some of you it's a little rusty. And my style is, I don't make assumptions, so it's fine. I'll go through it. But my only request to you is I'll sort of focus on, there are a few really important time value of money concepts. I'll show them to you. I'll use a calculator to show them. In fact, I probably have some screen videos on this that I did over the summer for my online class. Maybe I'll post it and you can see it. I don't know. But I'm doing it live here. So here's the homework that will familiarize you and make you fluent with this material. As you know, it's targeted homework. It's not like I'm just saying, do all the questions. And so please do that. Time value of money is one of the most important concepts. $1 today is worth more than $1 in the future. And you may think that, hey, that doesn't really, $1 today, $1 tomorrow. How about I say that, what do you think about $1 today versus $1 at infinity? And certainly because I've changed the dimension there, the answer is very clear to you. You'll say that obviously we'll take $1 today. In fact, if I can even change, I can say, would you like to have $1 today or $100,000 10,000 years from now, and you take the $1 today, right? Mr. Doherty, what are you thinking? That 10,000 years is not happening anytime soon, right? Yeah, not in our lifetime. You have plans for that? Did you see the cover of Time magazine this time? Like Google's final frontier, the search on death, that it wants to resolve death.
I did see something about
that. Yeah. I haven't had time to read it, but yeah. But Google puts his mind to it, he'll probably crack it. I did have a question to you guys. I saw a PBS program, a little bit on it, is why do we need driverless cars? Google is putting a lot of money in it. Of course, there's great amount of technology coming out of it. And they're pretty much, it's down to a science. And in fact, the accident rate on a driverless car is much lower than on a car that has a driver in it. They're doing it in California, on the Route 100, on 101 there, which is a very busy highway. Why would you want driverless cars?
So you can continue to work while you're in the car.
Really? Yeah.
Be more productive, especially if you have a long commute, 2 hours or whatever.
Yeah.
California, LA, you might have a long.
So one reason is you can continue to work. So it's ultimate multitasking. In a way, it's not multitasking. It's sort of outsourcing. Yeah.
Safety is another issue.
Safety, another issue. Yeah.
You get where you want to go without having to look where you need to go.
Yeah.
Google Maps, that's really why they're doing it.
Yeah. Yeah. But if suppose a part of the road gets washed out, or there's a little, problem there, part of the road gets burnt out, or the burning tree has fallen there, I guess it's active cameras, radar, sonar, they'll catch it. Yeah.
It's supposed to be able to see
Yeah.
things that you can't see
Yeah.
with infrared.
I think one of the things I picked up in that program was also that it's geared towards people who are not really well versed in driving, or who are losing their driving skills. So because taking the keys away from someone who's 75 years old is a very painful process, for them, But they'll still drive, because legally they can drive. So it's interesting. But there's definitely a lot of technology coming out of this. So anyway, back to this, So that's we were talking about the future, and Google obviously does a lot of things future. So this is how these things get triggered in my mind. I saw the future. So yeah, you do want $1 today, but then what if I say that would you be okay with $1 10 years from now, or $13 12 years or 13 years from now? Then we need to do some calculations, because now suddenly I've moved a couple of items there. The number of years I've changed, the dollar amount I've changed, and so what we can do is we can see the present value of $10 10 years from now today, and $13 12 years from now today, and we can compare it given the interest rate, and we'll actually have an exact answer. And so this chapter will help you answer that question. So that's the net of this chapter, okay? So for that, some very, very, very fundamental basics here. Let's see. This is called a timeline. How many of you are, I don't know should I frame the question positively or negatively? What would you like better? If I say how many of you have never seen a timeline, would I get show of hands there? Or how many of you have seen a timeline? I'm really asking that question. How many of you have seen the timeline? Okay. All right. Okay. All right. So okay. So it's good to go over it. So this is getting a little specific, and for the engineers out there, maybe you'll enjoy this, but you're already familiar with notation. This T0 always means now. It's now. So this is a cash flow now. One is one period from now. So this is at the end of the first year, end of the second year. I% is that the interest rate is usually specified on an annual basis. It can be on a daily basis too. Like if you go and look at your credit cards, they're clever. Of course they're clever. Why not? And it's not bad to be clever. But there's a difference between clever and cunning. So the interest rate, the periodic interest rate on the credit card is like 0.0018%. If you look at it carefully, it's the daily rate. So you can convert it to an annualized rate. But typically most rates are specified on an annual basis. So these are cash flows. This is your timeline. Basically, it's the timeline. This is a timeline for a $100 lump sum due at the end of year 2. So if you have 100 here, that means $100 are due at the end of year 2. Just that. Interest bearing, I% annual. There's another term called an annuity. You want to look it up. And an annuity is equal and fixed dollar amount over fixed intervals of time. So two items are fixed. The dollar amount is fixed and the interval length is fixed. So think of it as your car installment, your mortgage payment, or maybe even your rent. So these are like annuities. And they can be monthly, annually. In this case, it's just to simplify it because the idea is to explain the concept is annual. So it's $100 at the end of each time period. This is where we'll use some basic technology. Your calculator here. David, can look at that. Thanks. This calculator here, it's actually a very basic basic finance calculator, but it has a lot of good functions in it. You have a Hewlett-Packard, which looks nicer. There's actually a pro version of this, which is shinier, but this will get the job done. And it actually has a couple of buttons here, CF and NPV, which will handle uneven cash flows. Thank you. And so here the cash flows are uneven. So the way to read this is $50 was invested. Negative is actually usually good in the world of investing. It means the cash has gone away from you. Gone away from you typically means that there's been an investment. And then it generates $100, $75, $50. So I know some of this is very elementary for most of you probably, but I'm just setting it up real quick. I'll show you a few examples, and so it'll probably be more 35 minutes of this. What is the future value of an initial $100 after 3 years? So how would you calculate that? So if you invest $100 today, it's 10% a year. What is the future value of this after 3 years? So basically something like this is done by calling in a concept called compounding. So I'll show you the basis of how the compounding formula is established, and then I don't expect you to remember it. On top of it, it's already pre-built in your calculator, but it'd be nice to know how it actually happens. So let's say FV1 is the future value at the end of 1 year. This is what? Basically the present value plus the interest on that, right? So what is the interest? The interest is the present value times the interest rate. So PV, you take it out, and that's 1 plus I. So that's your $100 was invested, and 1, and then I is your interest rate. Remember, you have to convert the 10%. You cannot put the 10 as 10 because then it would become 11. So this is 1.1. So that's $110. Somehow, intuitively, I think all of you knew that if you have $100 invested at 10%, because 10% of 100 is $10, so that's $110. Well, what happens after 2 years? After 2 years, this 100 that you had invested becomes 121. How did that happen? Well, the FV1, which is 110, becomes your new present value. And then you have the same interest rate factor is called applied to that. And so this FV1, you can take this whole thing here, which is PV times 1 plus I is FV1. You put it here, PV times 1 plus I times 1 plus I, and so you get 1 plus I squared. So 11 levels are 121, so that's how you get 121. Another way to do it is just 10% of 110, that's $11, so that's 121. If you do it again, now this is where sort of homework starts coming in, So it's a different kind of homework. You don't have to turn this one in, but you can verify this. This becomes 133.1, and this is to the power 3. And so you can generalize that, and you can say after n years, you have FVN is present value times 1 plus I to the power n. Just that. As simple as that. And this is compounding. This is actually built into your calculator. Now there's a nonlinear relationship, between time and the future value of money. And doubling the interest rate, let's say from 5% to 10%, more than doubles the terminal value of your initial investment. And you can verify this by, let's say, you at 16 years at 5%, you can go this way and you say it's about $2.50. A dollar becomes $2.50 at 5% after 16 years. After 16 years at 10%, it's just a little under $5. I mean, this is not $2.50, it's actually less than $2.50. So this is more than double this. And you can actually, a better illustration would be between this and this here, from 10% or this to this, 10% to 20% here, you can see that this is double more. So at 10% for 14 years, it's about $3. And you go up here, and so this is more than $6 or $7. And so that's the power of compounding. Einstein is reportedly having said it. I'm not sure if he said it. He said the greatest force on earth is the power of compounding. And that is one reason why, as investors, and I'll show this to you towards the end of this chapter, is there is actually a value of time in the world of finance. You cannot catch up on lost time. So, especially to my undergrads, whose average age is about 20 years, I actually show them an example how each one of them is actually a millionaire. And you can save yourself that $12 book on Amazon on how to become a millionaire. And I've done a basic calculation. If the undergrad student saves about $130 a month, and assuming of course 8 or 9% a year, by the time they are 60, which is 40 years from then, they would have $1 million in future value. But if you start that at 40, it'll be much less than that, because between 40 and 60, you will witness this growth, which is another reason why you want to be very careful with your investments, because suppose you've done a good job between 20 to 40, and then you've seen the SPY VFINX chart that I showed before. If this goes down 40%, which happened to a lot of investors in 2008, people who worked at General Motors, let's say, for their entire lifetime, and they were going to retire in 2-3 years, and that was an index that was down 40%. Stocks were down 70, 80, 90, 100% in 2008. So imagine the pain and the suffering where 20 years you've done this, and then in the 21st year, and it just happens like that. So that's where you'll see the formation of my investment thesis and ideas. Actually, the biggest foundation for that is going to be done in the Harvard management case. Multi-period compounding is all just, I'm not going to go over the numbers here because later on we'll do that, is most often actually in the real world, interest is not compounded annually. It's actually compounded in multiple periods. Actually, it's compounded daily. So suppose it's quarterly, you have to make some adjustments. So if your interest rate per year is 8%, for quarterly it's 8 divided by 4, that's 2%. If your number of years is 6, now your number of periods is going to be 24, and that has an implication on future value. Well, we'll attend to that later. So 3 ways to find future values. You can use a calculator, you can use an equation, you can use a spreadsheet. So here's the same formula there which I showed you. They're basically 4 variables. If the third one, so here are the 4 variables, 1, 2, 3, and 4. If 3 are known, the calculator will solve for the 4th variable. No big deal. Just trying to launch the calculator in simulator mode here. Appreciate your patience. You'll find that the lecture format is a little different from setting up the portfolio and all that. It's in a way simpler. Suppose the interest rate is 10%, your investment is $100, that's how you read it, and you invest it for 3 years. We just actually did that the longhand way, the equation way. How would you do it using this calculator? So take it, you turn it on and off, and here are the specific finance skills, just FYI, I'll show that to you here, for the interest of the online students there. Well, guys, they can only got an HD camera and all that, but I've been advised, it's just you can't use the HD camera in its full resolution mode. The files became like huge. 6 gigabytes were recorded last day. 6 gigabytes. It's too much. Anyway, you got cash flow here, net present value, internal rate of return, and number of years, IY, interest per year, present value, payment, future value, and then there are a few others here. Okay. So you hit this on/off button. This is the time value of money row, and then you have clear TVM, amortization, periods per year, and so on and so forth. Number of years, 3. So do 3 and n. When you see this little triangle, so I'm also, just showing you sort of for the first time, is some of the, how to use this calculator with its idiosyncrasies. N equals 3. Interest rate is 10%. So you do 10 and then IY. Now there are two things here I did that I need to just briefly talk to you about for like 30 seconds. Is in the previous formula, if you notice that 1 plus I, we changed the interest rate to decimals. 10% became 0.1. But one of the good things about this calculator is you don't have to do that. So if it's 10%, you just put 10. So it's simplifying things, actually. Second thing, if you notice, is I did not do IY, I did not do, let's say, N. I didn't press N here, and then 3, I did 3 and then N. So you first press the numerical value and then assign it to a particular function button, okay? So the sequence is the number first and then the function button next, okay? Now this one is interesting. This is a big idiosyncrasy of this calculator. Is 100 is your investment. You enter it with a negative sign, and not this negative, but this toggle plus minus here. And that's your present value. Payment in this case is 0. And you do compute future value. And this star also means something. It means that's the output. And this, for first time, I use the compute button. Compute future value. You got 133.1. Now notice, you did quite a bit of calculations, with the equation mode. But here, why not use technology? And I'm all for it. Some of you, are there any in the class who did not get 133.1? Don't be shy. If you did not get 133.1, the reason is this. Or those of you in online, is hit second, IY, and this is set as 1. If you bought the calculator brand new, this actually defaults to 12. Because this calculator is used by auto loan specialists and mortgage lenders, and most of those payments are 12 payments per year. 12 payments per year. Here it's 1 payment a year only. So if it's 12, change it to 1. All right, enough of that. You have the PowerPoints with you. I'm just mentioning it. It's impossible to go over everything. You can use Excel for it. In Excel, invoke equals FV. The arguments will pop up, and you put in the rate, the number of periods, the payment, and present value. Basically the same information. Of course, the devil's in the detail. You got to change the rate in Excel from 10 to 10%, which is 0.1. All right. What is the present value of $100 due in 3 years if I is 10%? See, now it gets interesting. So this is like driving the car in reverse. And this is actually, discounting is more useful and more applied, actually, utilized rather, than compounding. This whole stock market is about discounting. So Apple comes up with a new kind of phone, Samsung comes with a new kind of phone, and the analysts are making forecasts about what the cash flows and the demand is going to be. But the price for those companies is determined now, right now. So that's the present value of those cash flows. So now you are expecting $100 at the end of 3 years. My question to you is, what is this present value today? So it's like driving a car, so you're still going forward, except that you have turned your car around and you're allowed to look in the rear view mirror. So it gets a little exciting. Try that. Actually don't. So here's your basic formula. All you have to do is just do some, just move this interest rate factor item from the left-hand side to the right-hand side, and there you have it. So $100, 1 divided by 1.1, and you got 75.13. See, here's an exact illustration of the simple one English line I mentioned at the beginning of this chapter, is that $1 today is worth more than $1 tomorrow. In other words, $1 tomorrow, the present value of it is less today. In fact, in this case, we know that it is $75. $100 3 years from now at 10%, its value is only 75%. And that is why, see, I can slide in something big here. Why the stock market gets hammered if the interest rate goes up, or why an economy where if the interest rates are going up is actually not doing that well. We all make references and remember our moms, right? So mom asked me, many times, said, hey, the interest rate is going up, it's good. I said, no, mom, if the interest rate is going up, it's not good for the economy. She said, no, I'm getting more money, So here's why it's not good. Simple arithmetic, forget microeconomics, macroeconomics, political economy, anything. Right here, your interest rate goes as your discount factor. If this 10 became 20%, right? If the interest rate was 20%, the value of $100 today, would it be more than 75 or less than 75? Case rested. I rest my case. That's it. It's as simple as that. And this is big ticket item. Everybody, their uncle and their aunt, they're watching the Fed for the first move of change in interest rate. The minute, right now the market is waiting, if the interest rates go up, a lot of people, they will move away, from high interest, from high risk securities to lower risk securities. Right there is built into that. Very simple. It's all linked. How can you do this using a calculator? See, I'm going to do 100 as FV. 100 and then FV is your future value. That means you are getting 100. So you put some money in a bank, you're getting 100. After 3 years, your payment is 0. So again, 0 and then payment. Now the interest rate and N are set from before. So just hit compute, present value, and there you go, minus 75.13. There you go. In fact, and people use fancy terms, simulation, all that. We can do a very simple simulation. Of course, you can write some code. I'll show you some spreadsheets there, but they're not part of the class. It's just like fun stuff, things I do when I'm bored. But let's say, the same example I said, let's say interest rates goes up to 20%. What do you do? 20%, IY, compute, present value. There you go. So if you're holding a bond, let's say, which has a maturity of 10 years, and the interest rate goes up. This is one of the most fundamental relations. We have a whole chapter on bond pricing, and it's the most non-intuitive relationship. See, we're talking bonds here today. We haven't even done stocks. The price of a bond is inversely proportional to the interest rate. If the interest rate goes up, the price of a bond comes down. Think about how non-intuitive it is. Just the way it's set up, you think, well, if the interest rate goes up, 1 plus I to the power n, the future value is going to be higher. Yeah, the nominal future value, but the present value will get hammered. So bond traders, they're afraid and they hate, interest rates going up. And I've shown it to you in more than one way. These are some very, very fundamental and non-intuitive relationships. Finance is not difficult, actually. It really is not. Finance is actually more of a philosophy. I mean, it's parts pure science, it's parts absolute art, but it's more of a philosophy, actually. And you'll see that. And that's what I'll get past the science and the art, and then actually you are already immersed in a way with, my philosophy on it. You'll see it because philosophy is something that you just have to grow up with, grow around with in the environment. So you can use a spreadsheet solution for that. Same approach. Nothing big. This is slightly interesting, It's usually an interesting little experiment is how much time will it take for the initial investment to double? So you can start with $1 and you say that how much time will it take at a given interest rate for it to double? So obviously the dollar becomes $2. You could make this $100, then this would be $200. No big deal. So you set it up in the formula and you see $2 equals $1 times 1 plus 0.2 to the power n, and we want to find n. So it's 1.2 to the power n equals 2 divided by 1, that's 2. So that's where you just invoke a little bit of like the power of exponent there. So y equals x to the power n. You take the natural log of both sides. So x to the power n natural log is n natural log x equals natural log of y. And so in this case, that becomes n natural log 1.2. So n natural log 1.2 equals log of 2. Divide this, and you get 3.8. And so basically, in about 3.8 years at 20%, you will, and that's obviously a very high rate, your money will double. There's also something called a rule of 72. By the way, real quick, you can do this with a calculator. So first I'm showing you the setting up in the equation, and then using a calculator. So here's 2 is your future value, payment is 0, present value is 1, which is an investment, negative. Interest per year in this case is 20%. And this time n is your variable, unknown. So then you don't hit n here, okay? And trust me, I'm making it look simple. When you start doing some of these examples, you realize that you're going to be hitting the wrong buttons, or the sequence is going to be incorrect. So then do compute n. It should be 3.8. See, we just had that, 3.8 there. Rule of 72 is something that helps you do these calculations on the fly back of an envelope. So 72 divided by 20, so that's what, 3.6 actually equals to 3.6, which, I mean, this is equal to 3.6, which is approximately equal to 3.8, which is what we had, So the rule of 72 is 72 divided by the interest rate equals time. And you can change it, So if I say that your money is going to double, if you give me your money, I'll double it in 10 years. So then what do I do? 72 divided by time. So 72 divided by 10, that means in 7.2% is the interest that you are giving me. If I say that the interest rate is 18%, so 72 divided by 18, so that's 4 years. If I say I'm going to give you 18%, you can quickly calculate that in 4 years your money will double. So it's actually a nice handy little tool, it's called the rule of 72. So these are things, and I know that, and I want to relax you. All of it is not going to sink in at this very moment. Not only is this university material, it's graduate material. So, just spend a few minutes at home and you'll be all set. Same thing, for in Excel, there's an n per function there. See, I'm changing. All of these examples, they look deceptively similar, but I'm changing the missing variable. In this case, the missing variable is the interest rate. So if I say that your money doubles in 2 years, your money doubles in 3 years, what is the interest rate? So how would you do that? Future value is 2. Present value is -1. Number of years you leave the money in there is 3 years. Compute n, compute IY. That's 25.99, By the way, the rule of 72, it requires a few data points. So, if it's less than like 5 years, basically, it's a very major approximation. Anything more than 5 years or 5 periods is fine. So here, same thing, already did that. Spreadsheets solution, there's a function called rate, equals rate. So equals rate, suppose you type in rate. See, this is what I meant. If you type in equals rate there, see, it shows you the arguments. These are all the arguments. So n per is the number of periods, payment, present value, and then is there a future value here? There's something called a type, which is a beginning mode, end mode, which I'll mention, and some approximation scenario there. But you just enter those and you should get the value. And play around with it. By the way, this is a nice quick segue. See all these things, how many of you have seen this sheet by now? All right, good. I built this sheet actually sometime in 2004, before I came to UMaine. And the constituents and the weights, they have not changed over the years. And I posted to you. I mean, this is actually proprietary material, so don't go post it on the web. But because you're part of 651, sort of like probably 150,000 securities, How did I drill down to 1, 2, 3, 4, 5, 6, basically 6. And then I have the risk-free bogey, SHY, and then the Russell 1000 as a benchmark, IWB there. And I know it's hard to see, but that's 12/31/2004. And this is like every 6 months, which is basically each class of mine. See here, I know you can't see it, but this is 9/7/2006. That's 2/23/2007, 9/4/2007, and so on and so forth. And then I stopped doing that. I did something else. I made it current, There's too many rows, unnecessary. So all this information from here is unnecessary at this point. But basically, I want to track the performance of a portfolio. Like all of you have a portfolio. So as you know, it appears like a tangent, but it's totally linked. And that's why I asked for a show of hands. I want you guys to start tracking your portfolios. Really. Especially if you think, it has multiple reasons, One is you'll get more out of what you're doing, as simple as that. And the other is, if you just say that, suppose you have $10,000 and if you're invested, wouldn't you like to know, And this is a way of knowing it yourself instead of waiting for that statement to come so that you can, if you want to make any changes, anything, or you want to think about it, you can do it. So you can do it, but the basic architecture is here. You can change some of the things and you can do it. This is a browser-free application, so you'll actually go and download the prices from the web. If you hit this button, live update prices now, and there's a little box here which says to put in your own tickers, go to MSN indexes. So in this tab, I'll briefly show you. This is where you need to enter your tickers, and then you'll have to rebuild the spreadsheet a little bit if you have more than 1, 2, 3, 4, 5, 6, 7, 6 actually, and these two will be the same. And I don't show this in my undergrad class, but here's the market neutral hedge. So I have, let me sort of zoom it a little bit. I encourage you guys to look at it and build something nicer than that. This is almost 10-year-old technology here. See, I'm keeping it simple. So here's Europe, emerging markets, and the US. So these are the 3 major equity subdivisions there. And then you have bonds, real estate, and gold. Just that. How simple. Most investors, they'll just have a few stocks. So if they live in Europe, they'll have some European stocks. If they live in Japan or Taiwan, they'll have these stocks. Or in India or in Brazil. If they live in the US, they're going to have 20 of these. Just by having these 3 ETFs, you are having an exposure to probably 100,000 stocks. What do you know about that soybean producing company in Brazil? How profitable that is, You have no clue, In fact, which one of you had a company called ESRX? I was pretty impressed with that company. Come on, you don't know the company you guys chose? You have to look at your sheets. It's a holding company. It looks like some pharmaceutical or something.
That was Express Scripts.
Yeah. How did you find that? That's a cash machine, that company.
It's a health stock.
You know about it?
Well, healthcare system's going to change this year. There's going to be a lot of prescription drugs being handled. And the name of our company is New Drug Financial, so we're looking into
Nice, nice. I like that, as they say on Wall Street, I'd rather be lucky than smart, Yeah, so if you just found a company like that, that's fine, but what a company, but the point is, you have all these diamonds out there. Some of them are uncut diamonds, rough diamonds, like Facebook was and Google was and Microsoft was. Microsoft, do you guys know the story of Bill Gates and all that? Have you read? Last night I got into that. I actually tweeted a picture of Bill Gates from his sophomore year in high school, actually. And of course, that started something else, not only Microsoft, but Facebook later on. So I had a sort of a unique black and white picture. Did you see that? No, there's just too many up there. Yeah, it's impossible actually to see what somebody posts. I can show it to you. But how do you locate? The point is, how do you locate these existing diamonds and uncut diamonds? And I've shown you a picture before when the class started. About the SPY. They go down, they go up. So you can have 20, 30 of these, the point is, or you can have all of them. But then, here's the big diversion. This is not a tangent. It's total change in investment strategy. Is sometimes these markets are down, as if you remember from that graph, they're down 20, 30% during those times. But we don't know when those times will happen. I know this is but we don't need the numbers there. Is during those times, bonds, real estate, and gold, they could be having a bull market. And so you position for that. Net, shut up, Pank. What are the numbers?
I have a quick question.
Yeah.
Is it incredibly complex to add more tickers to this, or is it fairly easy to figure out?
Somewhere in between.
Okay.
Yeah.
Okay.
Yeah. But see, that is again, it's again part of learning, Right? Do you agree?
Yeah.
Yeah.
I can't guarantee I'll be successful, but.
But there are three of you, Three of you, if you put your mind together, maybe in an hour you'll figure it out. If you don't know how to do something, just type it in Google. Believe me. Stacker Overflow. StackerOverflow.com will go there. The answers that are answered there are just amazing. Mr. Dorothy, you've been to Stacker Overflow? You have there, right? Huh? Everything there, right? Lot of smart. There are a lot of smart people. Have you really thought how many smart people there are in the world? No, you is laughing, huh? I finally got her to laugh. No, I have a thought on that. That's why I have only so much of, I get impressed by smartness only so much. Like 2% of the human population is biologically defined as a genius. 2%. So let's say there are 8 billion people, right? Now you guys know, how many million there are in 8 billion, So that's 160 million people, which is half the size of this country. Half the size of this country is biologically a genius, we're not talking even genius is used very lightly, like really a genius, So, but not everybody, a lot of them are what I call frustrated geniuses. That's my term. Frustrated genius is when an adequate amount of time and discipline has not, an opportunity, time, discipline, opportunity has not gone into taking that uncut diamond or that unpolished gold, and making it. So there's a lot, and as you know, the time that takes to make an NFL player, the time that it takes to make a cardiac surgeon, the time it makes to take a structural engineer is now about 25 years to 27 years. So much, So much time is required. So much of sacrifice is required, So, yeah, so Stacker Overflow, Sean said Stacker Overflow, it seems like it definitely has a high concentration of geniuses who go there, right? You should check it out. There's nothing to check out, actually. Stacker Overflow. It's Stacker or Stack. I think it's Stacker Overflow. But you don't have to. You type in an Excel question that, how do I use offset function in Excel? Type in that, it'll go there, And it's basically people like you and me who are answering those questions. But Heather, to get more specific, as you know, I can talk about the philosophy, but I can also get in nuts and bolts. You go here. Here's how you start. Click on this MSN. This is a special template. All you have to do here is put in your tickers here in this exact format. That's as simple. Cannot simplify it anymore, right? You go here, and here are your 6, 7 tickers. You change that to your tickers. The problem is, that's why I hesitated for a second answering your question, is if it has more than 8 tickers, it's not going to show up on this sheet. See, here's your 8th ticker. See, I'll show this to you here. So instead of IWB, I say IWM, okay? IWM. And actually, this is a good time, live update prices here. Notice IWB is here. The devil is in detail. I can do all this. Been there, done that. No, this did not. Oh, wait a minute. Oh, this is, oh yeah, the price here. This is actually hand typed here, but the price here, it refers to, see somewhere in there, it'll bring up that. There you go. See, MSN indices E18. Now, if you go to MSN indices E18, here's E18. See that? See, it brought up Russell 2000, which is not IWB, it's IWM. And if you remember from my initial, that IWM is an amazing ETF. So if I change this from IWM to IWB, which is what it was originally in the spreadsheet, this Russell 2000, when we see that, it changed it. See, right there, it updated it. Did you notice that little flicker there? So I'm just showing you, how it starts there. So you put your tickers there, and then you have to build this a little bit here. And but anyway, that's the construction part of it. This class is not really about Excel. It's not a computational finance class. But the bottom line of this is this here, guys. Because I also understand this is an intro class in finance. This is it. This is the net of this. This portfolio has generated an annualized return of 7.02%. The S&P has generated 5.41%. And the hedged portfolio, which was actually running at about 4.5% until last semester, is now down to 1%. That means with no market risk. Hedged means $100,000. In this case, it's $10,000. See here, right here. Actually, this is where I was. So I just did an equal shotgun approach. I mean, that's the only way to describe it. Shotgun approach. $1,666 in each of those ETFs. 6 of them, 16 sixes are 96, so that's about that. And see, here's your market neutral hedge here. So $10,000 long, and here's your $10,000 right there, short there. Right here, 10,000 right here. And it's all set up. So let's say to calculate this, there's sort of a big kind of formula, but you don't have to change any of those. But you just have to be careful when you bring in those here. And so just that. This year you can change. This year is price as of, it gives you the point date. So this portfolio is actually up 80.9% in total return space since the beginning. The market is up 58%. Now you see the value of having a bogey. It's like Usain Bolt runs 9 per second, but is that good or bad? You need to know 10 seconds. This is your 10 seconds here. So market generated 58. So you could have, so typically, like what I started off with, it's 80% of portfolio managers that underperform the market. So it's hard to beat that simple SPY, which if you think of it as the world's greatest portfolio by itself. You don't have to do anything. And it's very liquid. But the quest amongst the professionals is, can you beat that market? And so this is how I was tinkering in my garage for a long time. And I just published a paper, which you sometimes see actually, I'll talk about that. That's a MAC portfolio, multiple asset class, that has generated about 81% versus 58%. With no trading, by the way, and some of you were thinking, oh, do we trade on this portfolio? No trading, no readjustment, nothing. And here I can show you beta also right there. So there's lots, and I don't want to overwhelm you with it. I'm not going to ask you, a question on this and all that. But without this, it's just a bunch of those PowerPoint slides that my junior level students can read. This is not published in any book. Beta, how does the beta compare? The beta of the market, as you know, is 1. The beta of this portfolio is 0.67, which means if the market is down 1%, this portfolio is down only 0.67%. So in a way, 33% less volatile than the market. And you can see that this is just total volatility. The SPY is 21%, and this is about 17%. And see, all these numbers are all linked, 80.9 it builds. So this is, net. So, if you don't want to get into the minutia, some of you may want to. I have designed it. You can just look here and think about that. But it'd be good if you can track it. Now, I'm aware that not everyone will have the interest to do this. I had mentioned it, Heather, in that email. You can track your portfolio on Google Portfolio, right? So, that's fine, Just remember, if you do it on Google Portfolio or on Yahoo Portfolio, how do you handle the shorts? How do you enter a short position? Negative what? Exactly. Thank you, Mike. Negative. No, not the negative, the price. The price is going to get updated automatically. You will enter your initial holding, your purchase price. And if you are 100 shares short on IWM, just put in minus 100 there. Is there an option? Okay. Last time I looked, there wasn't, Yeah, so you can use that, Yeah. I am not sure, though I'm 99% sure, but I'm not sure. When I say sure, I'll 100%, I don't think it takes care of dividends, So dividends are not reinvested, so that's a big problem in it, And Sean is nodding in agreement. I like that, because that's a big problem. As I've shown you, dividends are actually more than half the story. And it's difficult to do that. And so that's why then you'll see, eventually you'll have to build these, And there's a whole, so there's, like I said, the buy side in the industry and the sell side, and in between are what are called the vendors, the financial information technology vendors. And the bunch of people who basically build these systems for them. Which actually, I know there was something. Oh yeah, so that we can have a frank and a fair horse race, and there are no points for who comes first or second. Yes, Shin? 1 second. I may have noticed in one portfolio that your holding price date was different. I think I'd mentioned it, but it could have been oversight. Trust me, oversight, no problem, is your prices on your portfolio holding report should have been Tuesday close, which would be the 17th. Just write down 17th with a circle, and if you don't have 17th as the holding price, once again, see, because there are like literally so many little errors, omissions, mistakes in each of this portfolio holding report. But that's fine. In your final report, make sure you use the prices as of 17th close. And I know for online it's probably lagged by a day, but it doesn't matter as long as all of you have the same date. Because I know there's a 1 day lag between this class, and then first thing in the morning I'll transport the video there. It takes them about a day, and but they try to do it as fast as possible. But it's not a big deal. But as long as everyone's on the same lane. Shane, you had a question?
How many dividend periods are you expecting us to kind of go through?
Well, it's a random. It's a continuous process. There is no government given specified date. Apple could declare a dividend tomorrow. Qualcomm could declare one day after. And that brings in a whole complexity, which is another topic actually. It's actually part of the big charts paper. But on an operational basis, the way you deal with it is if you go to Yahoo Finance, use something called adjusted. So maybe, okay, let me spend half a minute on it. Use adjusted prices, guys. Just write this down. It's not going to make sense. Use adjusted prices from Yahoo. It will save you a whole lot of headache, and also make your portfolio look better, because suppose you're long a position, if you are not including the dividends, you're hurting your performance. Adjusted prices. When you download the prices, use something called adjusted prices. See, this is all not part of, it's not scripted, So anyway, you hit live update here, and everything changes here. Anyway, let me show you real quick here. So let's say here's TLT. I already looked up TLT. The beta for TLT is wrong, 3.87, by the way. Most of you know that TLT is US long-term treasuries. It means it's 3.8 times more volatile than the stock market. Hello? I mean, this will have an implication. You know why it's having an implication? Because 70% of you use net beta in your portfolio holding reports. If your objective was to have net beta close to 0, and if TLT was one of your long positions, you would say you already have a high exposure there, so you would ratchet down the betas for the others. And so you would go towards defensive securities, whereas you should not have. Or if you have a short position, this is like a very, very, very volatile short position, so it impacts your contribution to other positions. Anyway, guys, so once you bring up TLT, let's say, or any security, so I'm showing it to you here, okay? It'll be difficult to show it again. Historical prices. Click on historical prices. And this is how you can start building when I build that tracker and all that, I didn't know. Nobody gave me any information. And so I just started looking at these things here. But it'll bring up this. Let's just, for the sake of it, just change it to monthly, 2002, 2013. And I'll show you the discrepancy. And it's not a mistake, by the way. These guys are actually doing it the right way. So I'm not biased against anybody. So yeah, I just showed you a mistake that Yahoo is making, and I'm saying that they're doing something good, which is sort of, I think, how it should be. But people sort of tend to take a stance first. They're like, don't like. You don't like something, then everything they do is wrong, right? It's not like that. September 3rd, it opened at 104, high was 107, low was 102, closed at 107. Adjusted close is 107.05. That's how it should be. That's today's price. Let's go back here. March 31, 2008. $95 is your close price here. What is adjusted price? 78. That difference between 95 to 78, which is what, $17. Yeah, about $17. $17 is the dividends that have been paid. If you add all these irritating numbers here that are not making your spreadsheet look clean and pretty, that will add to $17. $17 divided by 78 is probably about 20%. So if you don't use adjusted prices, you're losing, unless you can go and add each one of them separately. But between 2008 to today, it's paid $17 of dividends on an investment of $78. So here's another this is the complexity. So I don't want to create that kind of work. Here's the complexity. Like I just talked about 17th of September, right? Even online, guys, because you'll have to change the numbers in a second. Just do 17th September, end of Tuesday close price. Is whatever is your initial starting price on your holding report, it'll actually change, right? If you think about it. When you go back to September 17th on the last day of November, the adjusted price of IBM or Walmart will actually be lower, which is a good thing because if it paid any dividends. So all your prices are going to be different from what they are here. It's not making sense, but you have to live it. And this is as my math teacher used to say, this is not a mistake. It's a blunder that the websites are doing. This next paper of mine, is published in one of the world's top journals, and I was quoted by name. And I feel bad saying that, but just to indicate to you how significant it was in the Wall Street Journal, All these charts, it's like they're useless. They really are useless on the web. Yeah, a couple of places, yeah.
I might be getting a little ahead, but
No.
especially like a Barclays bond that pays dividends, why wouldn't you look at a Sharpe ratio instead of a beta?
Yeah, you're definitely really ahead of this, A Sharpe ratio and beta is, let me see.
So the Sharpe ratio is going to
Yeah. No, I'm trying to, Would you rather measure my pulse rate at this minute or my body temperature?
That's what I want to know.
The two are quite different. The Sharpe ratio is a relative measure of performance generated by Nobel Prize winner William E. Sharpe, who's still professor at Stanford. So the Sharpe ratio is the return on your portfolio minus your benchmark return divided by the standard deviation of the portfolio. The beta is an index of systematic risk, which is the covariance between security I and the market divided by the variance of the market. So the beta gives you how volatile and how responsive a security is relative to a change in the market. The Sharpe ratio gives you what the performance of a portfolio has been adjusted for total risk. So you're really, really ahead because we haven't talked, this is systematic risk, this is total risk, and then you got performance in here. If you want to look more of this, see, it's a very deep portion, and I love these questions, and this is the reason why I don't script it that much. As you know, I have my website. You just type in, correctcharts.com. I got there 3-4 versions of it. So proceed to the Return Finder's new quantitative site. So for the quantitative guys, I've made a new one here. And see, download the Cap and Beta correlation and risk file for the top 200 ETFs. And see here, Sean, you can get the Sharpe ratio. See, so Sharpe ratio is different. Sharpe ratio here, you have betas. In fact, there are two other measures of risk. Coefficient of variation, which is return over risk, higher is better, and the way I've recalibrated them, and annual standard deviation. Let's take a, okay, no, just hold on, let me just clear this out here. And check this out, there's some papers and all that. Actually, this is a good time. I'm going to just show this, some things here. So these are some files you can download. There's all free content there. Yeah, okay, here, this way. See, click on research here, but you'll see this research tab only if you go to this quant site. The other site, which is for the general population, it doesn't have that research tab, which has links basically to all my research papers. See here, publications for download review. This is on Wall Street, price charts can mislead. So that's where you'll find, actually, we're here, might as well just click on it. So this is price charts can mislead. This is by Simon Constable. This is the other one. There's no way. You have to go on the tangent, right? Because I can say, see this one here, why we can't tell if the market is half empty or not. Why we can't tell if the market is half empty or half full. And this was in July of 2011. And here is yours truly right here. Pankaj. So some of you may not know my name is actually Pankaj Agrawal. Has surveyed the chart displays. The slow, steady, and silent growth that dividend or interest income can provide over time isn't reflected on these price graphs. So I came up with a term which he mentions that it can afflict investors with what Mr. Agrawal calls an optical bias. And there are about 10 million people who go to these websites every month. And the media sort of probably has a reason why they don't want to change it. For example, underrating the importance of dividends and stock returns. And then other things there. And it's been written up actually in the media a little bit, not just the media, but the peer-reviewed press. And actually there are people here, so I can show you here. So people are asking for it, Here's a request from Canada. So all these places, So people who know, who are really investing, they're asking for this information tool. I'm looking for a site that does total return for charts, not just share price, and allows me to compare multiple stocks, ETFs, and mutual funds in overlaid view. Google Finance has very good multiple security charting, but it compares share price only, ignoring dividends reinvested, which makes it challenging to really see the true picture. Thanks. I mean, I could not have said it better, but what I did is I captured it and made a file out of it, and it's there, archived nicely on my site. So anyway, you guys can browse it. There's a lot. It took me months and months to put all this content, build this website, and of course, the app behind it, that was 40,000 lines of code. That's another story. But don't download it now, okay? Yeah, don't download the app now, because I'm very thankful for what I have. I don't want you guys to pay for the app. I'll make it free one day and then you download it, or if there are only a few of you, I can just give you the cash, because I've downloads from around 30 countries around the world, so I don't need that. But all right, so let's come back to this here real quick. See, I don't know, we went to Excel, we went to Excel, and I wanted to show you how that, see how we went on this. I'll tell you the genesis of that. I wanted to show you rate. So when I showed you rate, I needed Excel. I opened Excel, this was already open, and we went from there. But anyway, Heather and company, you can take this as a template and you can build something. If you don't want to, you can use Google Finance, Yahoo Finance. But I'm just showing you, because I can't, frankly speaking, as someone who knows a little bit, I can't just say that use what they have, because it's published. There was a Nobel laureate who reviewed my paper. It's incorrect, but yeah, you'll get an idea. You use that tracker, it'll give you an idea. But if you really want it right, it's like you want really organic vegetables, not just a stamp, you got to grow your own, right? Right? Really. When I see food, I see toxin nowadays. I got a problem. I got a problem with food. No, really, I got a problem there. So you got to do your own things. But how much, We'll continue on with this. I actually probably won't be able to do any more of this chapter. And so that's the end of this chapter 2, time value of money. Please continue on with this. Don't just stop there, guys, because this is very elementary stuff. Basically, I showed you the calculator. When we come back, Josh and Alyssa, they'll give us a Harvard management case, which is just, and I'm like, I bow to that case. It's just, have you guys enjoyed reading that case? Trust me, you go and ask someone, ask them, how do they manage a client's portfolio? They'll give you a lot of hand waving. They say, oh, we buy things that are cheap and we sell them high. But no, that was my question. How did you do that? No answer. This will get you there. Thank you.